aim in the quantum long-term value fund is to actually earn 2 times the risk-free rate of return in India. So whether it's an FD, whether it's a State Bank of India FD or we take a 10-year Government of India bond, what we call a 10-year GSEC, and we say the average rate has been about 7% as risk-free. I take risk to be in equity. I take risk to be in stocks. Companies may fail, companies have uncertain earnings, managements change, business cycles change. So I want to earn at least twice that risk-free rate of return. And the question we ask ourselves in our entire analysis is if the intrinsic value of a company, if I estimate it to be 100 rupees, can I buy it at a 25% discount today, which is 75 rupees? And if we are right, then 75 becomes 100. That's a gain of 33%. So unlike a T20 cricket match, we're not trying to hit a six on every ball. We're playing a very, very long term, not even a 5-day test match, but a long, long marathon in some sense. A marathon test match that runs 5, 7, 10 years. And you're trying to, make sure that every ball is not one that you swing at and not, but you slash outside the off stump, but you treat every ball very carefully and strike when the opportunity is there and present it to you. And we roll over this intrinsic value every few months. We get more information about a company, we roll it over. We can typically, as you can see from the last line here, our portfolio turnover is 20%. What that means if I have 100 rupees is that in the course of a year, 20 rupees I'm buying and selling, 80 rupees I'm holding static. But in terms of names, if I have 30 names in the portfolio today, chances are that only 3 names completely exit a portfolio or completely come in new into a portfolio. So that's a 10% by name that we talk about. So fairly steady long-term portfolio, no trading, no up and down buying and selling, not worrying about daily movements. And if I was to map out since 2006 that FY2E upside potential chart, that's what it would indicate that we should have made a 13% compounded annual growth of return. I mentioned twice the risk-free rate of return, which is 7%. So close to that. But markets have been kind. And what we've actually delivered is that 14.6% compounded annual growth rate. If I was to map the two together, the orange being what we've predicted and the blue being what actually happened, you can see that pretty closeness of that lines. And the only times you were wrong was on the left side when you had the Lehman bankruptcy, and on the right side when you had COVID. And those were shorter periods of time, which were global events, but they quickly caught up to what that long term trajectory of our expectation was in terms of what our portfolio will be. So the actual return was 14.6%, even though the estimated would have been 13.7% once you take the gross numbers and you remove the expenses of running a mutual fund, which in our case, the current expense ratio is 1.1%.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.